I want you to imagine a tsunami, but not the kind you see in the movies, where a giant wave crashes onto the beach without warning. I want you to imagine a tsunami where the water recedes first. You are standing on the shore and suddenly the ocean disappears. The fish are flopping on the sand. The coral reefs are exposed. It is quiet. It is eerie. And in that silence, you have a choice. You can run towards the horizon to pick up the free fish, thinking you have been given a gift. Or you can run for the hills, knowing that the water always comes back. And when it does, it brings the weight of the entire ocean with it. Right now, in the global economy, the water is receding, the signals are flashing red, and yet the stock market is partying. The politicians are telling you everything is fine. But there is one asset class that is running for the hills, one asset class that smells the coming wave before anyone else. That asset is silver. And today, with the price breaking $115 an ounce, silver isn't just running, it is sprinting. It is screaming at the top of its lungs that something is broken deep inside the financial system. Something that cannot be fixed with interest rate cuts or money printing. Something structural, something terminal. Today we are going to talk about why silver is trading at $115. We are going to talk about why gold is trading above $5,200. But more importantly, we are going to talk about why they are doing this now. Why are they exploding higher before the crisis has even officially started? Why are they front-running the Federal Reserve? We are going to explore the terrifying concept that the market knows something the public doesn't. We are going to look at the three fractured markets, retail, industrial, and futures, and how they are telling us three different stories. And we are going to discuss what you need to do to survive the volatility that is coming. Because if you think $115 is the end of the story, you haven't been paying attention. This is just the opening credits. Let's start with the price action itself. $115. If I had told you a month ago that we would be here, you would have called me crazy. You would have said, "John, silver moves slow. It takes years." But here we are. This is what happens when a compressed spring finally releases. For 50 years, the price of silver has been held down. It has been manipulated. It has been ignored. But you cannot suppress reality forever. The reality is that we are running out of silver and we are drowning in debt. When these two realities collide, you get a vertical move. You get a repricing event. We are not just seeing inflation. We are seeing a loss of confidence in the currency itself. When gold hits $5,200, it is the world saying, "I don't trust the dollar. I don't trust the euro. I don't trust the yen. I trust physics. I trust geology. I trust history." Gold is the ultimate collateral. It is the only asset that is not someone else's liability. And right now, the biggest players in the world, the central banks, the sovereign wealth funds, are scrambling to get their hands on it. But silver is the high beta version of gold. It moves faster, it moves harder, and it has an industrial kicker that gold doesn't have. Gold sits in a vault, silver sits in a missile, silver sits in a solar panel, silver sits in your iPhone. This means that silver has to fight a war on two fronts. It has to fight the monetary war against the dollar, and it has to fight the industrial war against scarcity. Right now, it is winning both wars. And that is why it is outperforming gold. That is why the gold to silver ratio is crashing. The market is realizing that silver is not just a monetary metal. It is a strategic element that is running out. Now let's talk about the concept of front-running the rescue. Historically, in 2008 and 2020, the pattern was simple. The crisis happens, stock market crash, the Fed panics and prints money, and then gold and silver go up. They reacted to the stimulus. But look at what is happening today. The stock market hasn't crashed yet. The Fed hasn't officially pivoted to massive QE yet. They are still talking tough about fighting inflation. So why are metals exploding? Because the market is smart. The smart money sees the writing on the wall. They see the cracks in the banking system. They see the rot in the commercial real estate sector. They see the interest payments on the national debt spiraling out of control. They know that the Fed must print. They have no choice. If they don't print, the U.S. government defaults. If they don't print, the banking system collapses. It is a mathematical certainty. So, the smart money isn't waiting for the press conference. They aren't waiting for Jerome Powell to announce the pivot. They are buying now. They are front-running the inevitable liquidity flood. They are positioning themselves in hard assets before the tsunami of paper money hits the shore. This is why the price is rising on no news. The news hasn't happened yet, but the market has already discounted it. By the time the news hits, by the time the crisis is on CNN, silver will be $200. The easy money is made by anticipating the move, not reacting to it. This brings us to the three markets theory. In a normal, healthy market, there is one price for silver. The spot price, the physical price, and the industrial price are all roughly the same. But in a crisis, the market fractures. It breaks into pieces. We are seeing this fracture right now. First, you have the retail market. This is you and me buying coins. This market is driven by sentiment and fear. Right now, premiums are high, inventory is tight, and people are waking up. But this is the smallest market. It is the tail wagging the dog. Second, you have the futures market. This is the paper price on the COMEX. This is the price you see on your screen. This market is driven by leverage, algorithms, and banks hedging their books. This market is often manipulated and disconnected from reality. It can trade billions of ounces of paper silver in a day, even if no physical metal moves. Third, and most importantly, you have the industrial market. This is the wholesale market where Apple, Samsung, Tesla, and Jinko Solar buy their metal. These guys don't care about charts. They don't care about Fibonacci retracements. They care about one thing. Do I have enough silver to keep my factory running next month? If the answer is no, they panic. They pay whatever price is necessary to secure delivery. The signal we are getting is that the industrial market is breaking away from the futures market. We are hearing reports of industrial users bypassing the exchanges and going directly to refineries, offering premiums to secure supply. We are hearing about off-market deals where massive amounts of physical silver are changing hands at prices much higher than the spot price. This is backwardation in the real world. The physical commodity is worth more than the paper promise. When the industrial users start hoarding, the game is over for the shorts. You cannot print silver to satisfy a solar panel factory. You have to deliver the metal. And if the metal isn't there, the price has to go to infinity to force someone to sell. Who will sell? Will you sell your stack at $115? Maybe. But will you sell at $200, $300? The market has to find the price that unlocks the hoard. I want to address the endgame question. Is this it? Is this the collapse of the dollar? My contact, the expert I spoke to, says, not yet, and I agree. This is the trailer. This is the preview. In a true currency collapse, you would see panic in the streets. You would see empty shelves in the grocery stores. You would see people refusing to accept dollars for goods and services. We are not there yet. Life is still normal for most people. They go to work, they pay their bills, they watch Netflix. This actually makes the current price action even more bullish. If silver can hit $115 while the average person is still asleep, imagine where it will go when they wake up. Imagine where it will go when the panic actually starts. We are in the insiders phase of the bull market. the phase where the people who know how the plumbing works are getting out of the blast zone. The public hasn't even entered the building yet. When the public tries to enter the silver market, a market so small it can barely handle a few $1 billion of inflows, it will be like trying to push an elephant through a keyhole. The price will have to go vertical to accommodate the demand. Now let's talk about volatility. I know many of you are looking at your portfolio today and feeling like geniuses. You see the green numbers and you feel invincible. But I have to warn you, the elevator cable is broken. Silver does not go up in a smooth line. It goes up violently, and it corrects violently. We could see a 20% correction tomorrow. We could see silver drop from $115 to $90 in a flash crash. And if that happens, you have to be mentally prepared. You cannot panic. In fact, you should expect it. A 20% drop in a bull market is normal. It is healthy. It shakes out the weak hands who bought on leverage. It allows the market to build a new base. The danger right now is leverage. If you are trading silver futures or options or using margin to buy mining stocks, you are playing with fire. The volatility will kill you. You can be right about the direction, up, but get wiped out by the shakeout, down. The banks know this. They will engineer volatility specifically to hunt your stop losses. They will smash the price down to trigger a liquidation cascade, steal your position, and then let the price rip higher. Do not play their game. Buy physical. Buy unleveraged stocks. Hold the line. I want to talk about mental accounting. Do not fall into the trap of thinking you are richer because silver is up. You are not richer. Your currency is just weaker. If silver goes to $115 but a loaf of bread goes to $10, have you really gained anything? You have preserved your purchasing power, yes. You have survived, yes. But you haven't necessarily gained wealth in real terms. The goal of stacking silver is not to get more dollars. The goal is to get more freedom. It is to have assets that are outside the system, assets that cannot be inflated away, taxed away, easily, or confiscated by a bank bail-in. When you look at your stack, don't count the dollars, count the ounces. An ounce of silver is always an ounce of silver. It buys the same amount of labor, energy, and food that it did in Roman times. The dollar is the variable. The dollar is the shrinking yardstick. We also need to discuss the central bank pivot. The market is pricing in a pivot. But what if the Fed doesn't pivot? What if they keep rates high to fight inflation? Then something breaks. The banking system breaks. The commercial real estate market implodes. The government defaults, technically or implicitly. In that scenario, we get a deflationary crash first. Everything sells off, stocks, real estate, and yes, even gold and silver initially. But that crash forces the Fed's hand. They cannot allow a deflationary depression. It would destroy the tax base. It would destroy the social contract. So they will print. They will print more than they did in 2008, more than they did in 2020. They will print until the zeros fall off the page. And that is when the real move in metals happens. That is the hyperinflationary phase. So whether we get a pivot now or a crash first, the destination is the same. Massive money printing and massive metal prices. All roads lead to gold and silver. It is just a question of the path we take to get there. One path is smooth, pivot now. The other is rocky, crash then pivot. But you don't need to know the path if you know the destination. You just need to hold on. Let's talk about the gold to silver ratio again. It is compressing. This is the classic sign of a risk-on move in the metal sector. When investors are fearful, they buy gold. When they are greedy or desperate, they buy silver. The fact that silver is outperforming tells us that speculative money is entering the sector. This is the rocket fuel. When the hedge funds and the algos start chasing the trend, things get crazy. We could see silver move $5, $10 a day. But remember, speculative money is fickle. It leaves as fast as it comes. That is why you will see those violent corrections. The long-term stacker doesn't care about the speculators. The long-term stacker cares about the fundamentals: debt, supply deficit, geopolitics. Those three pillars are stronger than ever. Debt. The U.S. is adding $1 trillion of debt every 90 days. Supply deficit. The world consumes more silver than it mines, and mine supply is falling. Geopolitics. Wars are raging and countries are de-dollarizing. As long as these three pillars stand, the bull market stands. It doesn't matter if the speculators sell. It doesn't matter if the banks smash the paper price. The fundamentals will eventually push the price higher. Now let's talk about strategy for the coming days. First, don't FOMO. Fear of missing out is a dangerous emotion. If you didn't buy at $30, buying at $115 feels painful. But chasing a vertical chart is risky. If you have no position dollar cost average in, buy a little now, buy a little next week. Don't throw your life savings in at the exact top of a candle. Wait for a pullback. In a market this volatile, pullbacks are guaranteed. Second, review your portfolio. If silver is now 50% of your net worth because of the price explosion, maybe it's time to rebalance. Not by selling for cash, but by swapping for other undervalued assets. Maybe swap some silver for land. Swap some silver for a business. Swap some silver for gold if the ratio gets too low, like 30-1. Always look for value. Third, secure your stack. At $115 an ounce, your stack is a serious target. Loose lips sink ships. Don't tell your friends. Don't tell your neighbors. Don't post pictures on Facebook. Get a better safe. Consider a private vault. The more valuable silver becomes, the more dangerous it becomes to hold it insecurely. You are now your own central bank. Act like it. Invest in security. I want to expand on the front-running concept. Who exactly is front-running? It's not just Wall Street, it's China. China has been stockpiling commodities for years. They know a conflict is coming. They know sanctions are coming. They are insulating their economy by holding hard assets. They are draining the West of physical metal. This is a geopolitical transfer of wealth. The West holds paper. The East holds rock. When the music stops, who wins? The guy with the rock. The signal flare that is $115 silver is a warning to the Western public. It is saying, your leaders have failed. Your currency is failing. Protect yourself. Most people won't listen. They will watch the stock market hit new highs and think everything is great. They are dancing on the deck of the Titanic. You are in the lifeboat. It might be cold and uncomfortable in the lifeboat, but at least you aren't sinking. Let's talk about the miners. In this environment, mining stocks should be exploding, and they are starting to, but they are lagging the metal. This is an opportunity. If silver stays at 115s, the profit margins for miners are insane. They are printing cash. Eventually, Wall Street will wake up to these cash flows. When the generalist funds start buying mining stocks, we will see a mania in the equities that dwarfs the move in the metal. But again, pick quality, pick producers, don't pick science projects. I want to touch on the psychology of $100. For a long time, $50 was the mental block. We broke it. Now $100 was the block. We broke it. Now we are in blue sky territory. There is no resistance overhead. There are no historical sellers waiting to get out at $120 because the price has never been there. This means the price can run. It can run fast. It can run until it finds a level that destroys demand. But as we discussed, industrial demand is inelastic. It is hard to destroy. So where does it stop? $150, $200, $500? Nobody knows. In a hyperinflationary scenario, price targets are meaningless. What is the price of silver in Zimbabwe dollars? Trillions. What matters is purchasing power. You have to change your mindset from how many dollars is my silver worth to how many ounces do I own. The ounce is the constant. The dollar is the variable. If you get this, you win. If you don't, you will be tempted to sell too early. You will sell at $150 thinking you made a killing, only to watch it go to $500 and buy a loaf of bread for $50. Don't trade your freedom for paper. Trade your paper for freedom. This brings us back to the tsunami analogy. The water has receded. The smart money has run for the hills, metals. The tourists are picking up the fish, stocks. The wave is coming. We don't know the exact day or hour, but we know the physics. We know the wave must come. The rise in silver is the first ripple of that wave. It is the warning siren. It is loud. It is clear. Do not ignore it. If you are watching this, you are already ahead of 99% of the population. You are informed. You are positioned. Now, you just need to be disciplined. Don't let the volatility shake you. Don't let the media gaslight you. Trust your eyes. Trust the price action. Trust the fundamentals. The system is breaking. We are watching it break in real time. It is fascinating, it is terrifying, and it is profitable for those who are prepared. So, take a deep breath, check your stack, lock your safe, and get ready. The show is just starting. 115 is just the opening act. The main event will be one for the history books. Stay safe, stay stacked, and remember, you are not wrong. You are just early. And being early is the same as being right if you have the patience to see it through. We will see you on the other side of the crisis, hopefully with our wealth intact and our sanity preserved. Good luck. You're going to need it, but more importantly, you're going to need silver. And thankfully, you have it.